Born to Build podcast.
Welcome to Born to Build, conversations with the builders, founders, and pioneers driving change from the ground up, giving you the tools to build and grow your business. Now, this is the third conversation in a three-part series where I'm chatting with the three co-founders of Libryo. If you haven't listened to the parts 1 and 2, I'd recommend you do that first. That will give you a bit more context to today's chat as well. So this series of conversation is very close to my heart because Libryo is the company that I've worked for since its early days. And today I'm chatting with Malcolm Gray, the third co-founder of Libryo. He's been the CFO for Libryo and now a partner at ERM. And before co-founding Libryo, he spent 16 years at Investec Asset Management, where he was global head of ESG. He's also a lawyer by training, a teacher on sustainability at Cambridge, and someone who brings together law, sustainability, and purpose in a really unique way. Malcolm, welcome to Born to Build.
Thanks, Sam. Yeah, it's great to be with you, actually. Really,
Yeah,
privileged to be with you, actually.
Yeah, such an awesome story, the Libryo story. Just briefly before we got to just pray together, and I just said in the prayer, I was like so thankful for this story, like getting to chat to Pete and Garth, and just renewed and refreshed thankfulness for the Libryo story, and it's just been so cool. Today we're gonna look at a different angle to the Libryo story, which is around funding and raising capital. And so Libryo has been a venture capital backed startup and gone through various funding rounds. But take us back to that moment when Libryo was born out of standards and legal. What was the conversation or the realization that made you, Pete and Garth, really decide, let's take this global and raise funding to do it? Take us back to those early days.
Sure. I'm actually getting goosebumps as you're mentioning it. I mean, you've chatted to Pete and Garth, and I guess like there's always going to be like different sort of perspectives on the story. I mean, to some extent, the origins for me go right back to when I first met Pete and Garth, the very, very first meeting that we had, which was in kind of like it's sort of a bit of a legend meeting now, because it was sort of based on Garth wanting to chat to me while I was still at Investec Asset Management, now called 91. So, and I said to Garth, no pontificating in a coffee shop. If you want to meet me, you're either going surfing or we're going to walk in Newlands Forest. So it was interesting, actually. It was like after that walk in the forest with Pete and Garth, I was already reasonably highly convicted that there was something here based on what they already had in terms of standards and legal. But I obviously didn't know the guys at all. Like we didn't come from the same group. We had no sort of like previous history, the three of us. Pete and Garth obviously knew each other well. So I took a bit of time sort of like getting to know them. And I'd said to them, look, how can I help? And initially it was really in a mentorship capacity. But quite quickly it was clear there was something here. And I was looking for a potential opportunity to invest into something at the time. And it was clear to me that if we were going to do something with the technology, or let's say the vision of the technology that could be built, it had to be global. Like there was no chance it would make sense to be a South African based company with a South African customer base. There's just not enough scale here. So I had that view very early in the journey. Pete in particular was grappling with the tension between a consulting business with a very linear type of revenue model and a software business that was very capital hungry. And so he'd been thinking about this, and you know how Pete works, like he often thinks and puts stuff down in writing. He's very good at that, and like built up a deck. And I remember meeting with him, probably won't get the sequencing quite right, but it must have been between July and August 2015. And Pete had this presentation about the sort of like two roads that had to be kind of like rode or ridden basically for the different businesses. And at that point, I came to the conclusion that I would I would make an offer to buy a stake of the then business Sustain Enable, which was the holding company of our consultancy, Standards and Legal. But
Mhm.
the deal would be that the capital I would put in would be fresh capital to fund the new business, Libryo. And
Right.
so it was at that point it was clear, and the only way to do that was really to have to kind of like do a venture capital funded opportunity. So in some ways, my initial investment was actually the really early angel check that went in to kind of like fund the business. Um, and there's a lot of like fun stories around all that, and maybe we'll get into that as well. But I mean, that was for me, that was the moment where I realized like, okay, this is an opportunity, but it's going to have to be, if we're going to do this, we're going to have to venture capital fund it. We won't raise the money in South Africa. I didn't believe, although I had quite good networks in South Africa,
Mm.
and we kind of went for the offshore kind of option. And Garth was then living, well, Garth had already moved to the UK. So that gave us a sort of at least a running start with somebody on the ground.
Mm.
Yeah.
What, like you were already like in you were in finance and sustainability, very secure, field. And what pulled you into the startup world at that stage of your life?
It's really interesting. So I didn't actually, I only met Pete and Garth after I'd already made the decision to leave the investment world. I'd been there, as you said earlier in the kind of intro, for 16 years. And I'd actually reached a stage of, to some extent, a bit of burnout, but also I felt I needed to learn some new stuff. And as an
Mm.
investment manager, I ran money for over 10 years, um, and ran quite big portfolios, launched a lot of like different funds. So I had a particular investment philosophy, but I felt I had an Achilles heel when it came to growth. I'm a value oriented investment manager. I like to buy stuff cheap. I don't like to overpay for stuff. And but the part that I was battling with a lot in the investment markets was the growth stuff, and how you sort of think about growth. So I decided that I was going to make a number of investments when I effectively retired or quit my previous job. And I put aside a pot of capital that I was going to invest in startups because I thought it would be a good place to sort of learn. And
Mm.
this sort of opportunity for Standards and Legal and Libryo came up like probably faster than I was almost anticipating. So that was the real sort of thing behind it. And then my heart has always been for sustainability. I'm a sustainability guy through and through.
Mm.
I've been in the sustainability space. I mean, I joke since I was 9 years old. My first like
Before it was cool.
environmental, before it was cool. Well, I don't know, it was coolish in a sense. But a boy living in Benoni who got excited about saving whales. There weren't any whales in Benoni. But so I've always had this sort of like sustainability as part of what I did. I went to university to kind of study geology and that, but ended up in the sustainability space and have been there ever since. Um, so I wanted to do something with sustainability. I felt really strongly about that. And what Pete and Garth introduced me to was a kingdom type business, which was a slightly different angle to what I'd looked at, but it sort of resonated with me as a Christian. So these sort of things all sort of like came together at the same sort of time.
Mm.
But I saw an opportunity to learn about growth, which was the thing I didn't really understand. And I have to say, I learned a lot. Pete Garth and I basically did an MBA in startups for the first couple of years, when we started the business. Because although
Yeah.
Pete had been in the startup space and had done quite a lot there, Garth came out of corporate, well, not corporate, but law, and I was more corporate. So there was a lot to learn.
Mm. So what made you put your own money down then eventually? You invested that first angel check. Like what about sustainable enable made you put your own money down?
I genuinely saw an opportunity to build something unique. I'd had a previous startup investment in the geolocation space, which had not succeeded. And I could see the mistakes that we'd made there. Um,
Mm.
and I don't know, it was probably a combination of a desire to learn, uh, a very interesting opportunity, an opportunity to build something global. I'd done a lot of research around what was in the space and realized there wasn't really anything particularly well developed in the space. Um,
Mm-hmm.
it felt to me like we were at the point where the technology wave that we would need to support the business was emerging. Like we weren't quite there yet, but the technology wave was there. Like you could
Mm.
see that the kind of particularly the stuff that you would need in terms of like machine learning and kind of natural language processing, those sort of tools were starting to mature, but they
Mm.
were emerging. And in my mind, I thought if that wave happens, like we've got the right sort of problem to solve with those technologies. As you know, Sam, because you've been around on the early journey, like
Yeah.
we were very early stage, like we were like cutting edge in some ways in terms of what we were trying to do, the problem we were trying to solve, and the tech wasn't quite there yet. I mean, 10 years on now, the tech has caught up for where we are, and we're still on the cutting edge on a lot of these sort of things.
Mm.
So yeah, that was the core of it. And I mean, I put in quite a big check, relatively speaking, but I just had conviction that there was something here. I think it was a
Mm.
combination of wanting to learn. I do believe that in some ways, I was probably touched by God in terms of like this was something to do. It wasn't, by the way, the only investment I've made, and it obviously became the biggest investment for me because over the course of the next, like, and we'll get into this, the funding rounds, I put in a lot more capital. But over the course of the last 10 years, I've put money into about 12 different startups actually.
Mm. And the money is the investment, but also you didn't think you'd put that much time into this as well, right? But that's
No,
probably the
no,
biggest
there was like a lot
investment,
of
really.
no. It became a huge amount of sweat equity as well, and that was cool. Like it felt like right, and so I ended up. In actually, part of the original deal was that I would put up the capital and I would put in about I think I can't remember now. It was 2 days a week of sweat equity for the first like year or
Yeah.
6 months. I can't remember what the exact number was. So there was no, I didn't get any payment for it, but I kind of earned up a sweat equity piece that effectively then
Right.
got monetized later. So yeah.
In 2016, then, Libryo incorporated in the UK, Seed Camp, Nextlaw Labs, pre-seed round. What did those early pitches look like? And what kind of reactions were you getting to this idea of this global legal tech thing?
Sure, that's actually a good point. I mean, Pete and Garth went off in late 2015 to a big tech conference, startup tech conference, which that year was in Ireland actually. And they sort of pitched the idea of Libryo uh, at that conference. And we started getting like interest in this. We didn't really know the name, like the international startup space was called Reg Tech. We didn't really know what that
Right.
was. And it turned out that wasn't exactly what we were doing, but it was kind of sounded adjacent and interesting. So 2015, there was enough people sort of sniffing around us that it was interesting. I mean, we didn't really have a proper deck or anything like that. I mean, we were sort of still kind of learning. Um, but part of what came out of that was a kind of like a startup crowd said, oh, they'll help us register a company in the UK. And we thought about whether we should register in the US or the UK. This was pre-Brexit, so in retrospect, maybe it wasn't like the right decision, but at the time it felt right. But we went with the UK. It felt like it had the best sort of legal system. It was part of Europe. It gave us a lot of kind of mobility around those parts of the world.
Mm.
And time zone wise made a lot of sense because Garth was on the ground there, so that kind of made a lot of sense. So we
Yeah.
registered. The company was registered on the 16th of Feb, 2016, but we didn't have any cash. And I remember being in the UK, and I had to. Garth and I met in Cambridge, and I transferred the first £5,000 into the Libryo bank account because we couldn't get the money out of South Africa because I'd done my funding in South Africa. So it was like, you know, global corporates, exchange control, all these sort of things. Anyway,
On that note, though, like, how does it actually work? Like as three South Africans, can you register, like, be directors in a UK based company without? I mean, obviously Garth had was living there and had a residence permit, but you guys weren't. So how did that actually
No,
work?
exactly. So you needed to have one resident. I can't remember all the law now, but like we researched it quite heavily, and given Garth and I are both lawyers, it wasn't something we were going to like mess around with. But there
Yeah.
was a lot of stuff in the early days that we had to navigate with a fair degree of like sort of finesse and robustness, to be honest. Um, but yeah, Garth was the first registered director that got us the company registered and also got us the bank account opened. It was only after that that Pete and I got added as directors. And you could have foreign directors. You needed to just have one director in the UK. So that's how we did that in the beginning. Yeah.
Mhm.
There's a lot. Like, the thing that everybody underestimates when you start a business is how much complexity there actually is. You know, like the
Yeah.
idea is cool and we've got the energy and we've got all that kind of stuff. But the truth of the matter is the stuff that will kill you if you don't have resilience and aren't organized is, my Lord, the amount of regulatory stuff you have to jump through, the fact that you've got to be a company, then you've got to have a bank account, then you've got to register for tax, and you've got to register for VAT, and you've got to, and nowadays with GDPR and all the other things, there's like, and like just, there were a few times where we nearly missed deadlines, and you got to file stuff, and like you're running wild in the early days, trying to just like keep the business. You're trying to find revenue, you're trying to find customers, you're trying to find staff, you're trying to, oh my Lord, you're trying to do all of this, and you got all this other regulatory stuff. Like, and yeah, like it was, we had a couple of near misses, I have to say, in the early days.
Sure, but you have done so amazingly. A lot of times single-handedly carrying a lot of that as well. As you were CFO, but also in a way, like a lot of the operations were, yeah, your baby as well. Yeah. But back to Seed Camp and the pitch decks and pitching or lack of pitch decks. What did that look like?
Yeah, I mean, we kind of like started putting together pitch decks. And look, there's a lot of resources online. So as I said, we did an MBA in startup, but the three of us just like really like dived in, and it was quite fun actually. There was a
Yeah.
podcast that Harry, he was a young guy, like a 19-year-old or 17-year-old guy, who started these podcasts talking to these startup founders. We used to like geek out on his stuff like all the time. We were reading every book and everything you could find about startups. So we kind of like started going through the processes of building up a startup deck. Seed Camp was running which is a UK-based early stage venture capital funding business, was running a competition, and Garth kind of like said, "This might be fun for us to go for." They sort of seem to have the right vibe, and so we put together a video. I think it was a video actually, because it wasn't actually a pitch deck. You had to do a video. We did it's somewhere on the internet. If
I
you
was
if
gonna
you dig
say, I
into the
think it's
interweb,
still online. It's still on
I think
YouTube
it is,
somewhere.
yeah. Some dorky video with the three of us like
Yeah, like
talking
almost like
about our business.
camcorder style, like.
Yeah, and we were also like, this was early days of a remote business. So like we had an office in South Africa. We had obviously an office. We didn't have an office as such in the UK, but we were in the UK effectively operating. And we had to do all the stuff virtually, So we got Garth on a screen and Pete on a screen. So it's like, anyway, we made this video and we managed to get into the round. And then Garth went and pitched. Pete and I were online. Garth pitched in person. Pete and I actually did the actual presentation, if I remember correctly, but I might be getting dude. I've done so many hundreds of pitches that it's like it's easy to get these things confused. But
Right.
at, Pete and I were sitting here. Garth was at the actual meeting in the room there, and we pitched, and yeah, Lord, I mean, we won. Like we were one of the 10 startups that was elected for this funding thing, and it was a joint call out by Seed Camp, and you've mentioned Nextdoor Labs, which was a venture capital funding arm of one of the world's biggest law firms called Dentons, and we in winning this, we essentially raised 100,000 euros. That was our first sort of like kind of real money that was going into the business, outside of the check that I'd put in. So yeah, that was basically when we went, okay, we're in. And part of the kind of win was not just the money, but they put us into like a program. And so Garth, Pete, myself actually were based in London and went through the Seed Camp program for like weeks at a time. as we sort of like went through the whole journey. And I must say, it was very helpful, like helping us get everything from financial models to all the other stuff that you just don't know, you don't know. And
Mm.
we were part of an amazing cohort, and we got really good support from Seed Camp. I mean, it was our home for 2, 3 years. I mean, that's where we had our registered office. And then the next little venture guys, Dan Jansen and his team, they were amazing as well. Like we had great support. I must say, very, very good support in those early days.
Yeah.
And so began the journey to try and raise more capital, because we were capital hungry. You know, we had limited revenue and we were very capital hungry.
So you mentioned, you've done hundreds of pitches. What advice would you give someone, preparing their own pitch? Like, what are the things like that you would say, yeah, you need to be aware of?
That's a really good question. You know, you've got to like link to like post Seed Camp. We won another kind of like startup competition, which was called Kickstart, where I moved to Zurich for 3 months to be part of that
Mm.
program. I, I think the key thing you learn about pitching is, firstly, you got to be very clear about what your value proposition is. And also you're going to do 1,000 pivots over time, and there's going to be all sorts of changes, but you need to be very clear about what your value proposition is. And you need to figure out how to tell your story in the shortest amount of time possible.
Mm.
Like one of the best things that happened over time was learning to pitch Libryo in 60 seconds. Could you pitch Libryo in 60 seconds? Like what are the sound bites that you need to be able to discern out of it? It's like you got to distill it and distill it and distill it. So you start with like a deck that can be 30, 40, 50 slides. It's all the stuff. And because you like the owners of the business, you got all this detail. But when you're trying to pitch for money, like those folks don't understand 90% of what you're actually going to be talking about. So you got to go through a process of distilling it and then redistilling it and redistilling it and get it down to like 5, 6 slides. If you can tell your story in 5, 6 slides, and even more impressively, if you can tell your story in one slide, then you've got a better chance of getting attention. Um,
Right.
and then you've really got to be able to understand the zeitgeist of the time. Like, if you're going to try to raise money for, I don't know, a mobility startup now, like, dude, you're dead in the water. Like, don't even try. Like, nobody's funding mobility startups anymore. Like, you should have been doing that like 20 years ago. But if you're raising money in the AI world now, well, good for you. Blockchain, yeah, nobody really cares anymore. So you got to like figure out the zeitgeist of the time. And if your startup's at the right sort of time, it's easier to get conversations. But even if you're
Mm.
trying to do, I don't know, a lawnmower startup, which just happens to, you've just found a new way of doing lawnmowers, doesn't mean you shouldn't do it. But then you've got to be very, very like clear and go look for the people that are going to be the right people to potentially talk to. Um, so yeah, distill, 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 get it as
Mm.
succinct as possible. That's probably the best advice I've got in terms of that. And be able to think of 3 or 4 key things. What is your what is your key value proposition? What is your market and what is your market size? Um, why you, as in why you, the group of people that are doing this? Like that's a big thing. Like, is there a founder fit for the idea? Like if you've never done anything in a space and you suddenly like you think that you're going to start up the next like I don't know, SpaceX or something, like why are you the right person to do it? Or why are the 3 of you or 4 of you or whatever the right people to do it? People sniff that out really quickly. Um,
Mm.
what is the kind of core finances? Like, how does this business work? Like, what's the business model and how would you kind of like make it work? And if you were to exit, what would be your exit? And that sounds like the weirdest thing, but you need to be thinking about how to exit a business almost at the time that you started. Every single
Mm.
venture capital guy will ask you, what's your exit? It's like, well, we never planning to exit. We're going to list our business. We're going to be $1 trillion, whatever. So, so yeah, I would say those 5 things are probably the most important.
Yeah. And that's actually such a valuable exercise. I think even if you're not trying to raise, actually preparing a pitch helps you think through like the key things of your business and help you understand your vision and your why. So I think probably worth doing even if you're not raising. Like it's just so it just helps to distill,
100%.
like
Yeah.
say, yeah. Now,
And you know what's actually interesting,
yeah.
just one other thing, and like if I look back now
Hmm.
and like we don't we don't reminisce about this a lot and go back and look at, but it's fascinating going back to look at your different pitch decks as to how you So doing this is actually quite a good discipline. Exactly what you're saying, Sam. In terms of,
Mm,
because that captures your thinking at the time, and you will see how your thinking evolves a lot over time. Like, I mean, you'll remember, Sam, like with Libryo, like it was 7 in 7. We want to do 7 continents. Obviously, Antarctica is not really a kind of a place for law, but 7 in 7. We want to do all the law for the world. And then when you get into it, you realize that you have to kind of like start narrowing and focusing your business more and more and more. So like these sort of like processes of documenting and like distilling your stuff down over time and recording it not only helps you get your business plan right for your early stages, but actually is a very interesting sort of chronology of how your thinking evolves over time as well.
mm,
So
yeah, brilliant. Yeah, maybe the seventh one was never Antarctica. Maybe it was space. The new frontier.
Mars, there we go.
It was. Um, so then you had a £950,000 seed round led by Energy in 2017. So that was obviously quite a major turning point as well. One first serious institutional round. How did that change the way you thought about, Librio's trajectory at the time?
Yeah, I mean we started getting attention. I mean, we were never like the hottest startup, but we were certainly getting attention. We had lots and lots of meetings. And when Energy, so I actually did the Energy pitch in London, must have been like late 2016, early 2017.
Mm,
And that was fascinating. It was a 5-minute pitch. I mean, we pitched for 5 minutes and we secured the funding. It was crazy. It was Energy led with, I think they put in £350,000. Um, we had already secured commitments from Nextdoor Ventures and from Seed Camp. And I had at that stage, which we don't talk a lot about, but actually, like very, very importantly, there were a number of other angels that were participating in the Library rounds. As I mentioned earlier,
mm,
I had reasonably well-established networks in South Africa, and so there
yeah.
were a group of guys, like mates of mine, actually, who actually put up reasonable amount of money into Library as well. But we'd secured a number of those angels to put money in as well. So Energy was the biggest check, and they were actually the latest check into the last check into the round. And at that point, we were able to pull the whole round together and actually do what was essentially, I guess, our first major seed round. You're right. I think it was about £950. That was the amount that we raised. Um, so yeah, that gave us confidence that we could kind of press the pedal harder. And no doubt we'll get into this, but sometimes you press the pedal too hard or not hard enough. It's always like a hard thing to sort of get right. But that gave us a lot of conviction to keep going in terms of what we were doing. And gave us the
Mm.
fuel to kind of fund the next sort of like 6 to 12 months of the business.
The friends and family thing is a little bit different in your case, where I guess the check size may be a little bit different. But how did that feel actually getting friends of yours to invest? And also, it's a very different story to getting outside investors. You got a lot on the line there as well, relationally. How did that feel?
Yeah, that was quite hectic. So I mean, it was interesting. I didn't actively go out to pitch any of my mates to actually put money into Libryo, but
Mm,
a number of the guys that put money in knew me quite well, and they were keen to get involved. Like they'd all got to a stage of their lives where they had some spare change, and they saw something that was interesting, and they knew me well, so they wanted to participate. But it sort of brought another dynamic of pressure on me because I felt a huge amount
yeah.
of like very personal accountability for the people that were putting money in. Um,
Mm,
so yeah, that added another layer of like quite a lot of stress because I didn't want to compromise my friendships, and I was very clear with every
mm,
single person who put money in. I mean, my best mate put money in, and I said to him, "Dude, like, I'm not prepared to put our friendship on the line for this money. So like you gotta like be very sure you want to do this. And if things go pear, which 99% of startups don't make it. So
yeah.
be prepared to write this money off." And I had those conversations with a number of the guys who put money in. And there was
Yeah.
one particular friend who in actual fact I wouldn't let him put money in because he did eventually very late in the process, but I kept him out of it for a long time because I needed to have like one of my quite good mates who wasn't like invested in Libryo that I could like talk to and know that he wasn't like worried if like things weren't going well, you know. So
Mm.
um, so yeah, there was a lot of personal stress there, but it was also great to. I missed that in a way because it was actually a great way of like connecting with your mates about stuff, and they were always keen to listen, and you know, so yeah, it had its stresses, but it had huge benefits as well, and I'm very very grateful for what they did in supporting us at the time.
Mm.
By the way, the one person we never talk about is my wife, who, in actual fact, because Colleen and I ended up putting quite a lot of money into Library over each round, and she was always like there backing us up and going, "Oh, sure, let's do this," because you know,
Wow.
like any good marriage, it's a partnership, and so it wasn't
Mm.
just my money that was going into Library; it was also her money as well.
Yeah, sure. Amazing. Then a couple of years later, you came the seed extension round, so another 1.45 million pounds, again led by Energy and um, various others as well. What did that round represent in Library's growth story, and how had your approach to fundraising evolved by then?
Yeah, I mean, the context there is quite important because you know, Library was coming of age as COVID happened, and we all went into lockdown. So we we raised our last round just before lockdown, and then we raised. So that was the 950 round, and then the next round was actually raised fully during lockdown. Um,
Mm.
so we actually had a particularly good year the first year of lockdown. And I think it was because we were a business that was fully remote, so we were used to working remote. I think a lot of businesses who weren't remote really battled to sort of pivot towards a remote work environment. And like the world has fundamentally changed since then around remote. So we had quite a good year. Our revenue grew quite nicely that year. Still not as fast as we needed it to grow, but it was growing nicely. And given the tough challenges around COVID, it kind of gave us um, a quite a good story to tell, and hence we were able to raise this round. That round was correctly led by Energy, but actually one of the biggest checks and it wasn't actually that round, just to be clear, and we haven't really talked about the nuances. There are different ways that you raise money. Like sometimes you raise it on convertible debt instruments, sometimes you raise it as direct equity. This round
Mm.
was actually raised on a convertible debt instrument, actually. Um, and a big check actually came in from the UK government uh, as part of a COVID funding plan for startups. So we were
Mm.
actually able to benefit from that. So we had the UK government as effectively an indirect shareholder, but a significant stakeholder in Library for a number of years, which you know we were also really grateful for, and I think it was you know testament to the vision of the people at the time that saw the opportunity to support startups through the COVID period. Um, but that round gave us a big chunk of capital, you know, 1.4, 1.5 million pounds. And we decided to push the accelerator quite aggressively at that stage. Um, we did not anticipate that COVID would like linger as long as it did. Um, and our ambition was to enter the US market because that's where we actually thought we would get the best sort of distribution and growth. But with COVID, there was no traveling, and you know, a bunch of non-American sounding startup entrepreneurs were not getting the kind of
Yeah.
we were getting a lot of attention, but we weren't getting the ability to close. We just weren't closing deals in the US that year.
Mm.
And our revenue disappointed relative to the cost base that we started to build. And you'll remember, Sam, we built quite a big dev team through that period. And we got to a point
Mm.
where the revenue wasn't coming and we were starting to run out of that funding. And we had to think like really, really carefully. Eventually, we ended up having to retrench like nearly 50% of our staff, which was a really
Mm.
difficult phase of the business. So, you know, you're doing all this fundraising and like you're perpetually fundraising. I mean, one of the mantras in the world of startups is like always raising. You're always raising. It doesn't matter what you're doing, you're always raising.
Mm.
But you're also trying to grow your business. And so we raised that round. It was a convertible debt round, which I mean, I don't think there'll be time today to get into that, but like that can be both a blessing and a curse because now you've got a big debt and debt sits ahead of equity, which means that if you didn't survive, those debt guys would get paid back first before any equity shareholders would get anything. So it was
Yeah,
quite an
maybe just
onerous round.
quickly briefly explain what a convertible note actually is? How does it work? Be interesting.
Yeah. So, I mean, in brief, a convertible note basically is a form of debt, but the debt can convert into equity at a predetermined price. But if you
Right.
don't hit a certain milestone, if you can't get to the point of conversion, then they've got a claim on the business as creditors, which is different from
Mm.
being an equity shareholder where you're not a creditor, you're just an owner. And so
Right.
you sit in the kind of, let's call it the capital stack. A creditor sits above an equity. Equity sits at the bottom. They're the last people to get anything. But all the
Mhm.
creditors, staff, etc., they all sit above. So these guys essentially sat above. Now, most of them were also equity shareholders, so they were vested. But like the UK government, particularly, and one or two others, they were only debt holders at the time. So
Mm.
it's it can be quite an efficient way of raising capital, particularly when can't price your business because you don't really know what your business is worth. So you're not sure what
Right.
price to sell your equity at. So you basically raise debt with a potential price in the future. But if you
Right.
don't survive, then those guys will take your business or whatever's left of it.
Mm.
Or so, so yeah, so that's where debt sort of works. And these convertible debts, effectively, when you get to another round, that debt will convert at a certain price. And we'll get to
Mm.
it now, but we did actually get to a converting event, which was a positive, but also came with some quite big pressures, which we can talk about briefly now as well.
Yeah. So I mean, just quickly, someone, an investor, investing as a convertible note, that's, I guess, then a lot less risk to them. And but like, so you'd only really do that if you can't really raise in any other way. Like, is that how it works?
Yeah, not necessarily. The big issue there is that it sometimes makes sense to raise as a convertible note, largely around the valuation issue, trying to value it. In actual fact, it's pretty common in startup land today with your first couple of rounds to actually be convertible note rounds. Like if you get
Okay.
into if you get into like very early stage investors, and we did that with our first round of debt. Remember the seed camp round, the seed camp next lab round? That actually was
Mm.
what they call a safe, which was basically a debt round actually. So it came in as debt with its intention to convert at the first equity raising, which they did convert then. So it's not an unusual tool to use in startup land. But later, as you go into later on rounds, it can have some quite onerous implications. If you have what's known as a down round, which means that let's say you've raised at $1 and then you raise your equity at $2 and then you raise at $3 and your convertible notes are priced at 350 as a conversion rate. So they're going to convert at us, or let's say they're going to convert at 250. But then you have a down round and you can only raise, now your investors say, well, the company's only worth $1.50. Those convertible guys will convert at $1.50, even though the capital they got was, so they get more of the business as a result of a down round. So convertible
Right.
notes are great to raise, but if you have a down round, they become very expensive equity.
Yeah. And then in 2022 came the bridge round as well. Is that what you meant in terms of the complications, or?
Yeah, exactly. Yeah. So we were getting to a point where it was clear we were going to need to do something to kind of like find a big daddy for the business, or we were going to have to raise a really big round. And the investors who'd been with us for the last 5-6 years said, look, we're pretty much at the end of our sort of time horizon. Some of them funds are closing. They're like all sorts of other things that happen in the background. And
Yeah.
so it became clear that we needed to think about negotiating an exit or a partial exit of the business. But we were also running tight on cash as we continued to grow the business. And so we actually raised a bridge round. It was also, we were at the time, we were close to potentially finding an exit partner. And in order to exit the business, we needed to clean up the cap table. And the cap table is the table that sort of like has got all the different shareholders, debt holders, staff option holders, etc. And so we needed to do an equity round. So we raised an equity round, but it was a down round. We priced it at a lower price than the previous equity round had been raised at, and so the debt holders converted at an attractive price for them. But it was quite impactful for some of the for some of the shareholders who didn't convert, who didn't participate in the debt round, should I say.
Mm.
But it was an important round in Libryo's history, because if we didn't raise that, I don't think we would have been able to stay alive to the point that we finally got to the exit. So
Yeah.
it was probably, in the history of Libryo, that was probably the most important round of all the capital we raised. Obviously, all of it was important because we'd never got there, but that one got us to get to exit. It was a very difficult round to negotiate. We were in the back end of the second year of COVID. Everybody was like pretty freaked out about what was happening. Although the
Mm.
markets were going crazy, um, startups were not getting funded at the time. There was almost like no funding in
Mm.
the startup world at that stage. So we were in a bit of a startup drought. So it was a very key round to get away, and it was. Um, I actually couldn't get anybody in on the round initially. We were really battling. And so Coles and I said we would actually front the round. So we actually fronted the round. We put up the majority of the capital. As you said, it was about a £450,000 round. Coles and I said we would like put up the majority of it. Um,
Right.
it turned out we didn't actually need it to. And it's like one of these weird things in funding. Someone's got to be prepared to put in the big check, and then it creates conviction, And so
Right.
once we did that, like a lot of people decided to come in and follow. And that then forced the conversion of the convertible debt round as well. Um, so, so yeah, it was a very important part of the Libryo story, and
Amazing.
got us to exit.
Just explain something to me that you meant. You said you had to clean up the cap table. What does that mean?
Well, at that stage, we had equity shareholders and we had convertible debt shareholders. So, and we had a lot. Like we'd raised from, I think, probably about 15 to 20 different entities over the course of that sort of 7-8 years. So we had a lot of different shareholders, and we had different instruments. We had sort of typical equity instruments, the sort of early seed guys, and then we had these debt. And a buyer doesn't want to take on the complexity of having to have debt and equity and negotiate with 20 different people and all that kind of stuff. So
Yeah.
that's essentially what I mean by cleaning up the cap table. First, we needed to get the debt sorted out. So we converted that to equity. That meant that we only had an equity table now that we had to deal with. And so that sort of started to tidy it up in terms of like making it more manageable for the buying entity to negotiate with the actual sellers. Uh,
Mm.
so that's really what I mean. And there's a few more complexities to it, but that's probably the most important.
And then we've obviously talked about the ERM acquisition with Pete and Garth a bit already as well. But I'd love to kind of hear from you as well. What did that feel like for you? Obviously, you put in a lot of your own money there over the years as well. But yeah, what's going on emotionally?
Yeah, look, I don't know. Like, so I'm not, I mean, having been a guy that's worked with and managed like a lot of money, and I'm weirdly not a money guy in the sense that like money is not like a massive like driver for me. And I
Mm.
have this like philosophy in life, like once I put an investment in, if it doesn't turn out, it doesn't turn out. I don't get like, I try not to get too emotionally attached. For me, the emotional attachment was much more to the business. And as I
Mm.
said earlier, the responsibility I felt to other people who had put money in. And I didn't want to be that guy who'd kind of like sold a story, taken people on a journey, but never delivered. So for me, there was a lot of like, let's say, reputation. I felt like personal reputational risk or pressure there. Um, so and then also importantly to our customers and to our staff, we'd been delivering a really impressive service. People loved what we were doing. We had such loyal staff members. It was so important that we found a way of making sure the business survived. And so that to me was a huge amount of like personal pressure that I felt. And then the process of negotiating the deal, again, like there's
Mm.
a lot of complexity in negotiating a deal. When you're exiting to a big corporate, you go through incredible sort of like levels of due diligence, and there's a lot of like complexity involved in selling your business. Uh, so, so yeah, there was a huge amount of relief when it was done. I mean, I really did. I mean, I worked on the deal for the better part of a year. Um,
Mm,
And I mean, I was deeply supported by all of you guys. You know, I mean, you'll know what it was like. We went through the due diligences and that kind of stuff. But I think probably fair to say I probably carried the bulk of the, let's say, the operational pressure around the deal. Um,
for sure.
I mean, I'm obviously incredibly supported by Pete and Garth and everything that they were doing and keeping running the company and that. But I felt a huge amount of personal responsibility to get this thing to work. Um, so yeah, there was a huge amount of relief, but like also a huge amount of like joy, to be honest, like
Mm,
real joy that we come up with an idea, executed on it many different seasons, but we'd found a buyer who genuinely saw value in the company, saw value in the staff, saw value in the customer base, and wanted to keep going with us. And I mean, testament to that is that Pete, Garth, and myself are still involved. Like we haven't, not
mm,
like in many startup environments where you exit and then you walk off into the sunset. We didn't do that. Like we saw this as an important next stage, that the stewardship of the business shifted, i.e., the people that were owning it, but we felt a huge amount of personal responsibility to get Libryo to the next stage. And so the journey's continued, amazingly.
mm. Yeah, and I don't think there's anyone else in the business that believes in Libryo, the product and the business as much as you do. I honestly believe that. I've said that, at various times, and I really think that has been so helpful as someone, an employee, as someone working, a colleague working with you. That's always been super inspirational, seeing your passion for the product, for our customers, and how this is really serving a need that in the world that hasn't, the world hasn't had before. So that's always been super inspirational. But just in closing, time's coming to an end. But yeah, I'd love to just give you an opportunity, just some closing reflections on this journey. Maybe even what are some things that are maybe possibly misunderstood about raising capital, especially in the VC space. But yeah, and just some reflections on this journey.
Sure. Like there's a lot in that to wrap up on, but um, I mean, firstly, it's a real privilege to be able to do things like this. And I think, you never take for granted like the opportunities you get to start a company or to, I mean, Pete always said like one of the greatest privileges, one of the most stressful moments, but one of the greatest privileges is paying staff monthly. So like there are all these like little nuances along the way. Um, I think the truth of the matter is it's a privilege and a joy to be able to start something. It brings a lot of pressure and stress, but that is part of what makes it all so sort of like all encompassing. Um,
Mm,
I think I think when it comes to starting a company and raising funds, we live in an interesting time where interest rates were so low and there's almost like in some parts of the world now, and I don't want to say this is true in all parts of the world, but there's almost like an expectation that if you start something, you're entitled to get capital. And if it doesn't work, it doesn't work. And c'est la vie, it's fine. You kind of move on. I think that like
mm,
slightly disrespectful view of capital is wrong. I think like it's an immense responsibility if you take other people's money to, and they give you their money in good faith to do something with it and do something with it properly. I I
mm,
I sense that there's a little bit of um, hubris in the startup space over the last sort of like 5 to 7 years, with a bit of a disrespect of capital. So I think it's important that if you want to raise money, do it honestly, do it truthfully, do it with really good intent, with a true belief in what it is that you're building. It's not just a roll of the dice. I mean, people's in some cases, people's hard-earned capital, even if it's coming from an institution behind there, might be, people that are saving their hard-earned savings to um, kind of make sure they've got a decent retirement or pay for their kids' education or something like that. So be
mm,
respectful of capital, be grateful when you get it, be accountable for what it is that you've got, be transparent, and if you approach it with those sort of principles in place, and you genuinely believe in what you're doing, it'll be immensely rewarding, irrespective of the outcome. Then, because I think if you're open and transparent about the journey you're on, and it doesn't work, at least the people who you've taken capital from will know that you gave it your best and you were open and transparent. But if you're kind of like sort of a bit too privileged or a bit too that you believe that's your right to get the capital, then I think you'll burn a lot of bridges. So
Mm.
yeah, I think raise capital humbly, respectfully, and execute as well as you can in the context you're in to give your customers, your staff, and your shareholders, the best possible outcome. And if it doesn't work, which in many cases it doesn't, be humble about that. And if it does work, be humble about that too, because
Mm.
it's definitely not guaranteed. And you don't do this alone. You do this with a lot of support along the way. And in our case, I think the hand of God was very much involved in what we've done so far, and hopefully will continue to be.
Thanks, Mark. It's a privilege to call you colleague, friend, boss. But yeah,
Thanks.
amazing to chat with you today. Super insightful, really some great nuggets that I've taken away today as well. But yeah, thanks for your time.
A pleasure, Sam. Thanks so much. And yeah, well done to you and all of your efforts in this space as well. It's great to be sharing these sort of stories and kind of supporting the next generation. So thanks, man. Appreciate what you do.